Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, we got the Fed Philadelphia's 3-month Coincident Index in here. Once again, this is looking back and over economic growth across the country. We've been monitoring this very carefully over the last few years because what we want to know as community bankers is what kind of pressure will there be on interest rates? Will they stay low? Will they start to move up in here? And we've used this as really the barometer in terms of the economic growth that we're seeing across the country. So when we look at this particular quarter, up 0.8%. How does that compare to over the last year average? 0.7%. This is indicating probably a GDP in the neighborhood of 2.5% to a touch over 3% on an overall basis this year. Once again, we had a fairly low number in the first quarter, which there's expectation we're going to see that revised upward. But when we look at the rest of the year going out, it still indicates interest rates are going to remain in this low area that we've been living with for so very long. Well, what do we do in here to basically survive this period? The point that we've talked about before is net overhead. So we want to look at the difference between non-interest income and non-interest expense for community banks across the nation. Still in here, not broaching that 2% level where we've been over time. Just a touch above 2%, which would indicate that those net overheads really should be coming down across the nation. And the key to that are certain initiatives. Like at Seafried and Brew, we have our McGuffin method, which can point out certain ways to really increase non-interest income and decrease non-interest expense. When we look at it from the standpoint of, we talk about taxes and the tax efficiency. And the point that I keep on making is that community banks are not tax efficient. One of the strategies we've talked about before is looking at bank-owned life insurance. Have you maxed that out in here? And within that whole situation, you want to come up with a tax plan. This cannot be done over a 6-month time period or a year time period, but really must be looked at as a 3 to 5 year plan. So when we see the national average approaching 30% effective tax rate, that in reality with a tax plan is that 20% should really be closer to where a community bank reaches their overall tax efficiency. So think about it from a net overhead and also a tax efficiency standpoint that we, as we talked about before, margins compressing somewhat for the national benchmark group, meaning that earnings could be heading down in here as we move through a continued low interest rate point. Let's do some strategic planning and figure out how to turn that around. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.